Good morning, student. Today I am going to teach accountancy for 11th class. Today date is 27th May 2020 and this is my lecture number 8A. Now topic and chapter is accounting principle. Accounting principles. Under this chapter I will read many accounting principles. First, I want to explain about theory base of accounting. Theory base of accounting consists of principles, concept, conventions, rule and guideline developed over a period of time to bring uniformity and consistency to the process of accounting in order to enhance its utility to various users of accounting. In addition, accounting standards issued by the Institute of Chartered Accountants of India also constituted the theory-based accounting. Now, meaning of accounting principles. Unlike in the past, when accounting statements were largely needed by the proprietor, these days the accounting statements are needed by various parties who have vested interest in the business, namely proprietors, investors, creditors, government, and many others. Accounting statements disclose the profitability and solvency of the business to various parties. It is therefore necessary that such statements should be prepared according to some standard language and set rule. These rules are usually called GAAP, GAAP, generally accepted accounting principle. These principles have been generally accepted by accountants all over India. GAAP, generally accepted accounting principle. These principles have developed over a course of period from usage, region, common experience, historical statement of individual, professional bodies, and regulation of government agencies. So, this is the meaning of accounting principle. Now, nature or characteristics of accounting principle. Accounting principles are uniform set of rules or guidelines developed to ensure uniformity and easy understanding of the accounting information. So, uniformity is nature or characteristics of accounting principle. B. Accounting principles are man-made and are derived from experience and reason. They are not laboratory tested, and hence they lack universal applicability like the principle of physics, chemistry, and other natural science. So, lack of universal applicability. Next, accounting principles are not static and are bounded to changes with the passage of time in to the changes in business practices, government policies, and needs of the users of accounting information. So, we can say it is not static. The general acceptance of an accounting principle depends upon how well it satisfies the following three criteria. First may be relevance. Relevance means if it results in information that is useful in user of accounting information, principle should be relevant. Second is objectivity. A principle is objective if it is free from personal bias or judgment of those who furnish the information. Objectivity also implies verifiability, which means that there is some way of finding out the truthfulness or correctness of information. Now, kind of accounting principle. kind of accounting principle, means type of accounting principle. These principles can be classified mainly into two categories. First category is accounting concept or assumption, and second is accounting conventions. First, I will explain about accounting concept. Accounting concept or assumption have the same meaning to all people, and to make it more meaningful, most of the accounting have agreed on a number of concepts which are usually followed for preparing the financial statement. These concepts provide a foundation of accounting process. No enterprise can prepare its financial statement without considering these basic concepts or assumption. Now, these concept or assumption are A. These concept or assumption are A. Going concern concept. Going concern concept or assumption. Going concern concept. As per this concept, it is assumed that the business will continue to exist over a long period in future. The transactions are recorded in the books of business on the assumptions that it is a continuing enterprise. It is on this concept that we record fixed assets at their original cost, and depreciation is charged on these assets without reference to their market value. For example, if a machinery is purchased which would last, say, for the next 10 years, the cost of this machinery will be spread over the next 10 years. For calculating the net profit or loss of each year. So, I can say that it is also because of the going concern concept that outside parties enter into long-term contracts with the enterprises, give loan and purchase the debentures and share of the enterprises. Another example of this concept is that prepaid expenses which have no realizable value are shown an asset in the balance sheet because the benefit of such expenses will be received in future. Now, second concept, consistency consistency concept. This concept states that accounting principle and method should remain consistent from one year to another year. These should not be changed from year to year. In order to enable the management to compare the profit and loss account and balance sheet of the different periods and draw important conclusion about the working of the enterprises. If a firm adopts different accounting principles in two accounting periods, the profit of current period will not be comparable with the profit of preceding period. For example, a firm can choose any one of the several methods of depreciation, that is a straight line method, written down value method, or any other method, but it is expected that the method once chosen will be followed consistently. So, likewise, the method of a stock valuation or making provision for likely bad debt should remain consistent with the previous year. Otherwise, the decision taken on the basis of account will be misleading. So, consistency concept should be followed. C. Accrual concept. In accounting, accrual basis is used for recording of transaction. Accrual basis is used for recording of transaction. It provides more appropriate information about the performance of business enterprises as compared to cash basis. Cash basis of accounting and accrual basis of accounting. There are two bases of accounting. Accrual concept applies equally to revenue and expenses. In accrual concept, revenue is recorded when sales are made or services are rendered, and it is immaterial whether cash is received or not. Similarly, according to this concept, expenses are recorded in the accounting period in which they assist in earning the revenue, whether the cash is paid or not. Thus, to ascertain true profit or loss for an accounting period and to show the true financial position of enterprises at the end of accounting period, all expenses and income relating to the accounting period are recorded, whether actual cash has been paid or not. So, with compared to cash basis of accounting, accrual basis of accounting is more fruitful. Now, next point is other accounting concept, business entity concept. Business entity concept. business entity concept is treated as a unit separate and distinct from its owner, creditor, manager, and other. In other words, the owner of a business is always considered as distinct and separate from the business he owns. Business unit should have a completely separate set of book. That means business is separate from its owner. The proprietor is treated as a creditor of the business to the extent of capital invested by him in the business. The capital is treated as a liability of the firm because it is assumed that the firm has borrowed fund from its proprietor instead of borrowing it from outside parties. So, because of concept of separate entity, the proprietor's house, his personal investment in securities, his personal car, and personal income and expenditure are kept separate from the accounts of business entity. Now, next point is money measurement concept. Only those transactions and events are recorded in accounting which are capable of being expressed in terms of money. An event, even though it may be very important for the business, will not be recorded in the books of the business unless its effect can be measured in terms of money with a fair degree of accuracy. For example, accounting does not record a quarrel between the production manager and sales manager. It does not report that a strike is beginning, and it does not reveal that a competitor has placed a better product in the market. It does not record the lockdown period of COVID-19. These facts are happening cannot be expressed in money terms and thus are not recorded in the books. It should be remembered that money is the only measurement which enables various things of diverse nature to be added up together and dealt with. For example, a business on a particular day has rupees 50,000 in cash, 5,000 kilograms of raw material, 10,000 kilograms of finished goods, 5 machines, 100 chairs, and 20 fans. All these things cannot be added up unless expressed in terms of money. In order to make a record of these items, these will have to expressed in monetary terms such as cash rupees 50,000, raw material rupees 2 lakh, machinery rupees 5 lakh, etc. As such, to make accounting record relevant, simple, understandable, and homogeneous, they are expressed in a common unit of measurement, that is money. Now, next point is accounting period concept. Accounting period concept says business is intended to continue indefinitely for a long period. The true result of business operations can be ascertained only when the business is completely closed up. But ascertainment of profit after a very long period will be of little use to the proprietors, managers, investor and other, because it will be too late to take corrective step at that time. The users of financial statement need to know the result of the business at frequent intervals. Thus, the entire life of firm is divided into time intervals for the measurement of the profit of the business. 12-month period is usually adopted for this purpose. According to the amended income tax law, a business has compulsory to adopt financial year beginning on 1st April to ending on 31st March in the next calendar year, as it is accounting period. Now, next concept is cost concept. Cost concepts. It is also known as or historical cost concept. Cost concept. According to this concept, an asset is ordinarily recorded in the books of accounts at the price at which it was acquired or purchased. The cost becomes the basis of all subsequent accounting for the assets. Since the acquisition cost relates to the past, it is referred to as historical cost. This cost is basis of valuation of the assets in the financial statement. For example, if a business entity purchases a building for 20 lakh, it would be recorded in the books at this figure. Subsequent increase or decrease in 20 lakh, it would be recorded. It would not be recorded in the books of account. If 2 years later the market value of building will be suppose 30 lakh, the increased value will not ordinarily recorded in the books of account, because the cost concept or historical cost concept does not mean that asset will be continuously shown at their acquisition price for as long as business entity owns them. Their cost is subsequently systematically reduced from year to year by charging depreciation, and the assets are shown in the balance sheet at cost less depreciation. Now, the justification of this concept. Justification of cost concept. This cost is objectively verifiable because the cost recorded in the books is derived from an actual transaction and is not arbitrarily determined. It is justified by the going concern concept, which assumes that the enterprise will continue its activities indefinitely, and thus there is no need of using the current value or liquidation value. Market value or current value of assets are difficult to be determined. The revaluation by one expert will not be the same as that of another expert. So these are the justification of historical cost concept. Now, student, I will explain next many concept in next video. It will be lecture number 9A. For till time, thank you very much.